Let's bring in RBC Capital Markets co-head of Global Financials Research, Gerard Cassidy. Gerard, great to see you. Are you expecting any surprises tomorrow?
We're really not. I think tomorrow what we should all expect is that the banks will all pass in flying colors like they have for a number of years of, going through the DFAST stress test. Where we could see some positive surprises is that there are some banks that may see their stress capital buffers shrink this year. One name that stands out here is M&T Bank. They have a higher level of commercial real estate loans than their peers, which gave them a higher stress capital buffer, but they have brought that number down a fair amount. So we anticipate that will be to their benefit. Plus, the stress test this year has lower credit losses in commercial real estate, which will be another benefit for them. So we think them and possibly even the big money centers in the sense of Goldman and Morgan Stanley may see some relief as well.
In terms of what you're expecting and how the banks' businesses look, particularly the large cap banks, and we got a read from Jefferies today, and traditionally we've looked at Jefferies as sort of an indicator as to what to expect when bank earnings do start. They said that they see resilience in investment banking and capital markets, that they're very, they're optimistic about the second half of the year. Can we read through to the rest based on these results?
Yeah, absolutely. They're all in the same, ballpark. They're different sized players, of course. And I think what you're going to hear from the big banks when they report numbers in July is that April was a very difficult month for investment banking because of the tariff news. But each subsequent month in the quarter, it became better and better. And so I think what we're going to see is that the guidance that has been given out for investment banking revenues to be down generally high single digits for most of the investment banks, and then trading revenues driven by equities will be up mid to high single digits. I think those numbers could come in a little better in July because of the strength of June, and it's obviously ending very shortly here.
Gerard, you're in the Hall of Fame. We say it all the time. But you mentioned the stress test, so let's just talk about it. Because if Silicon Valley Bank were under the auspices of the said stress test, they would have passed with the flying colors that you just talked about. So my question to you is, if that is in fact the case, what good is the stress test?
Yeah. Thank you for your comments, Guy. I would say that what's really good about the stress test, it tests for liquidity and it tests for credit quality. Now, where it didn't test for and does not test for is on this interest rate shock. And ironically, when they test for it now, what happens is in an economic downturn, rates generally go down. So you need to see an environment or a test totally separate than what they do on stressing for rates spiking up, which of course is what happened in 2023. So the stress test really, its real focus is on credit, and that's what it was designed to do. And it's done, we think, a very effective job on credit. As you know, Silicon Valley did not fail because of credit. It failed because of the duration mismatch on their balance sheet.
Stuart?
Yeah, Gerard, my question would be about the banking pipeline. Obviously the volatility in April kind of disrupted things. How full is that pipeline, and how do you expect the banks to message that pipeline in July?
It often comes with a lot of bluster, and it's going to be great. The pipelines are big. Rarely have we heard, investment banks, point out the pipelines are poor. You just don't kind of hear that. That being said, though, there appears to be a real buildup of potential activity because of the uncertainty we saw in March and April. We anticipate that, yes, we will see more mergers and acquisitions. This administration, just from a M&A, not just in banks, but in the industries, all different industries, this administration is very supportive of that. We believe, Bessent, Treasury Secretary, I think is supportive of consolidation. We know deregulation not only is affecting the banking industry, but we're going to see it in energy, we're going to see it in other sectors, and that will, I think, bring on more consolidation in the other sectors as well.